Good morning, everybody. Thank you for joining us bright and early. Before we start, I want to thank Nick at Capital Lake for hosting once again, which should be a great panel. And I want to thank our panelists for joining as well. So with us today, sitting to my immediate left, Richard Tyrrell, CEO of CLCO. We have Art Regan, CEO of Energos Infrastructure, and Oystein Kalleklev, CEO of Flex LNG. So this is the LNG carrier panel. We'll certainly touch on carrier rates and the space, also touch on downstream markets as well in terms of floating regas and storage. But the best place to start probably is with rates and with headline rates. And I want to start with going to Richard first. Richard, since you're one of the few companies that has some market exposure here, LNG carrier rates have enjoyed a really prosperous multi-year period. I think they're off maybe 5 or 10% week on week, but at a very firm level. And CLCO is, again, one of the handful of companies that actually has some market exposure here. So maybe a little bit of color from you to start with what kind of inquiry you're seeing for your vessels, where you think the market actually is, both on a short-term and a longer-term basis, and then just any color around how you think about locking those vessels up.
Sure, happy to, Mike. And I know what your last question is going to be, which relates to the short-term rates, and I'm not going to give away my bargaining position, so I'm not going to answer that question.
Still going to ask later, but that's okay.
However, I think that does tell you that we are in live discussions on the assets that we have. We have got one asset which is open this year, and we've got a couple of assets open next year, which are amongst the legacy fleet, call it, which are the ex-Golar ships. And then we have a couple of new builds open next year as well, which of course is a slightly different, more infrastructure type of market. The rates have been phenomenal over the last little while. We saw our peak rate at 140, which was for 12 months. We had a number of 3-year deals at 120. The rates have definitely come off slightly from those levels for term business, but they're still fantastic by historic standards. And we're going through the cycle now where we're moving from 60, which was a typical pre-war level, up to something new. And whether it's going to be 140, 120, or even if it's 90, it's still going to be significantly above where it was in the past. Where are things going to level out? Well, clearly, it makes no sense for intermediate TFDE vessels to make more than modern two-strokes over a long period of time. But the modern two-strokes, of course, are going up in cost. And that's setting the rates at a higher level, and everything else is hanging off that higher level, which is good news for the TFDEs.
Oystein, I'd like to get your color on this. Flex for a long time, had quite a bit of market exposure, and relatively outspoken around your thoughts on rates. So I'm curious, what do you make of the current spot market, and specifically looking at where we are now versus where we've been for the past 2 years? Do you think we've already seen this cycle's peak, or do you think we've got another 6 to 12 months where we could get some positive seasonality and see, rates that are, bordering on silly?
Last time I was there was October 2018, and I had to catch the plane home because next day we did a $300 million equity issue and bought 5 more ships. And after that transaction, we had 13 ships. And at that time, rates were $200,000, and we had 13 ships basically open or spot. So what we have done in Flex the last couple of years is gone from a kind of speculative asset play, where we contracted 13 LNG carriers when prices were $185 million each. Today it's $265. So we bought the right assets, and then our plan was to put long-term contracts on them, and actually our planning was to do that in 2020. And COVID derailed that strategy for a year or so, but from 21 and 22 we have been fixing ships, and today we have our first fully open ship in 27. And of course the reason for that is we do see 24 and 25, it's more ships than molecule hitting the water, just like Jørgen explained. We do have a lot of ships for delivery when there are limited supply growth, and then from 26, 27 onwards, we do see a lot more volumes coming to the market, both from Qatar, but also from the US, and that's when we get ships open, 27, 28, and we think that is the best window, because we are competing against ships costing $265, but $265 is just the yardstick price. You have interest rates now of about 5%. Lead time is like 4 years, so these price of these ships are like 285 when they hit the water. So they need, as Richard says, they need a high rate to kind of defend that investment. So 100,000 or so for 10, 12 years, and that means we can reprice our ships in the term market because we basically have the same ships. They're just coming off charters at that time. The spot market today isn't really functioning anymore because like us, other people have been fixing ships on term charters. So today the spot market is totally dominated by relets, meaning big charters are reletting ships for shorter periods, and there are very few independent ship owners left in the market. Richard has one ship in the spot market, but except for that, there's very few ships in that market. And the main focus for us today, I will say, is the term market. We do see some prints in the spot market. It's about 200,000 for modern tonnage today, which is fantastic rates, but there are very few fixtures.
Makes sense. I don't want to bring Art into this, but sticking on spot rates for just a moment. Now, I know most of you don't have direct exposure to the spot market today, but based on what you just went through, where do you think, if you had a prompt delivery today and you were going to deploy it in the merchant market for 3 years, what do you think the average rate would be?
We do have actually market exposure on one ship, so we have one ship on a variable hire time charter linked to the spot market, so we do get some juicy earnings on that ship, typically in the winter season. If I were Richard and I have one ship open in October, I believe, I would probably rather look at doing a 12-month time charter because it's so hard to be in the spot market when you're competing against Shell, BP, Exxon, Chevron, all the big players and the traders. And when there's a cargo that's going to be shipped and this is put through the broker system, the brokers are always going to prefer the big players. If you are a small ship owner with one ship, you are down on the list, and it's going to be hard to fix that ship even if you are discounting your rate. So I would rather try to fix the ship on a term charter, 12 months or longer, rather than compete against the big players in the spot market because the liquidity is so low today.
Art, same question to you. Just
I'll give you a number.
Good.
If you're looking for a number. I would say like Richard was saying, there is a range of types of vessels. So from an older steam vessel to a modern fuel-efficient vessel. So for a modern vessel, let's say 125,000 a day for 3 years would be an acceptable rate in today's market, and that's a good return. So the market is still quite flush right there. So that would be a good return. We would take that.
Richard.
Mike, when you're in the market for a ship, I'll tell you.
Okay. Fair enough. Maybe switching to term-oriented business and what I know you guys are spending most of your time on. I'd like to speak a little bit about tendering activity, right? So the potential to place big blocks of ships or even a couple ships with portfolio volumes, large projects, and maybe we can go down the line or if anyone has anything different to add. But Richard, what kind of tender activity are you seeing right now? And maybe without giving names, maybe scale of that tendering activity, region, any color would be helpful.
Sure, and I think when you talk about tender activity, you're talking more about the long-term charters. So these are the infrastructure type deals, maybe more applicable to the new builds. And there, I think most of the projects which are well known and coming, they're pretty well covered. So you're not seeing a huge amount of tender activity in that area. I dare say people like Next Decade might start looking at taking ships in the future. But in general, the forthcoming projects are quite well covered. The tender activity today tends to come from slightly different types of customers. It's partly the Japanese customers, which have got quite large fleets, including a lot of steam turbine ships that they're looking to replace. And of course, they run quite rigorous processes around any vessels they take. And then you have the big portfolio players. A lot of them have quite big fleets, so they're always looking to add an extra ship here and there. So I think the activity today is not so much specific to projects, it's either the Japanese importers or it's the big traders and portfolio players.
Art, anything to add?
So what we do at Energos is predominantly real marine infrastructure. So the regasification assets is the largest block of our assets. So that's a different kind of tendering process and a different demand scenario. Everything in the world is active today because of really what happened last year with Russia invading Ukraine. Everyone is reevaluating what their energy matrix should look like for the next 10 to 20 years, and it's not just energy transition, it is now energy security. So the marine infrastructure for LNG now, when it comes to that asset class, is in a very, very exciting sweet spot now, and the tender activity continues in Europe. It exists in South America in a big way, across Asia now, for multiple drivers, not just the transition component for decarbonization, but also for security. So it's really worldwide now. We're quite busy.
We have very limited kind of experience doing these tenders because we fixed 13 ships ranging from 3 to 10 years, all of them without doing tenders. We think that, in 2020 we were the biggest operator in the spot market. We had all the ships open, and we created a good relationship with a lot of our customers, which were very happy with how we run the ship, with the physical assets. So based on that, we fixed all our ships through bilateral discussions with charters rather than going through this long and painful tender process. So we're not really focusing on tenders. There are, tenders from time to time. Qatar is probably going to order more than 100 ships on tenders. Of course, we looked into that. It's like 35 ship owners worldwide participating in a race to the bottom. There's not going to be a lot of value left there, except for maybe the ones running the tenders. So we're not focusing on tenders. We are focusing on talking to the big charters and having a good relationship based on trust, and then rather, if they have a need or requirement for a ship, we will be there to push our ships ahead of them and see if we can do a deal without going through big tender processes. But that said, as Richard mentioned, there are always big projects. In America this year, we have had a couple of FIDs. There are still a couple of FIDs where people are working on that. If you're doing a big project, let's say 10 or 20 million tons, you don't want to FID those kind of volumes. Let's call it 10 million tons, and suddenly everybody know you are short 20 ships, because then the ship owners with available tonnage, they're going to adjust upward the price if they know somebody is short 20 ships, because the yards, as Jørgen mentioned in his presentation, they have a lot of backlog now. They don't really have capacity to suddenly add 20 new LNG carriers. So that means that if your people are developing a project with that kind of volume, they will typically try to secure at least a majority of that freight need before doing the FID, so they are not being caught short in the market. So we do see some of those players, sending out tender requests or meeting ship owners bilaterally to discuss if there are possibilities.
I'd like to stay on that for a second, in terms of exposure to either portfolios or projects, be it through long-term tenders, shorter-term charters, or just business with portfolio cos that happen to have exposure or equity volumes in one of these projects. We've seen some very high-profile projects globally pause, right? So obviously Arctic 2, where you've had some owners that have deployed capital towards Arc 7s. You've got Mozambique, which I know Total started talking about restarting this year, but we'll see. And then you've got some other projects in North America by AAA-rated sponsors, right? So Exxon, QP, Shell. And the common theme here is that everything is paused or massively delayed, right? So when you guys think about your exposure to these projects, I'm curious how you think about it from a credit perspective. There's a degree of insulation based on your type of employment, but I think it'd be helpful to kind of run through with the audience how you think. What should they think about when they see Golden Pass pushing for commercial operations into early 25, right? Or LNG Canada kind of continuing to slip. Like, how does that impact you as a ship owner?
I think, you know, there's not only projects slipping, there are also some projects that might materialize which we didn't think gonna materialize. This year we had, you know, Plaquemines, Port Arthur, recently being FID'd. We do see some projects like Delphin, Mexico Pacific, and Commonwealth, where people thought these projects are dead, and suddenly they are signed up 70–80% of the volumes, and might do the FID. So there's not really that much slippage. I think the one that are the most notable is, of course, the Mozambique LNG, where it's been delayed and derailed for quite some time. But on Golden Pass, I think they are on time, and the volumes will be coming, you know, basically when announced. LNG Canada slight delays, maybe because of COVID, but it's not material delays. Some projects like the Venture Global project's been very quickly ramped up, even though it's all commissioning cargoes, to the irritation of some of the off-takers. But the volume's been in the market. So I'm not too worried about too much slippage, but I'm more worried about the unbalance of the order book, where we do have a lot of orders 24 and 25, when there will be limited volumes, because the volumes takes off from end of 25 into 26. So you might have some time with low utilization of the fleet, especially given the fact that Europe is gobbling up most of the spot volumes, meaning shorter sailing distances. So I think that's more of an issue than kind of delays of liquefaction trains.
Art, Richard, anything to add?
Yeah, I think it's not so much the credit which you look towards for the types of counterparties that you're talking about on the whole within this business, but it is the knock-on effects that additional shipping has on the short-term market. And of course, how do you deal with that? Well, you look at your portfolio and you make sure you don't have that much exposure over that period. So in our case, out of our 11 ships which are on the water, we've got 3 of them which are exposed over that period, and the rest of them come open in 2026 and beyond. It's that portfolio effect which you use to manage the potential downturn. So
in the regasification infrastructure, the credit counterparty, it's a huge issue, because you're signing up for 10 to 20-year contracts, and you're really reliant on that credit. So as a discussion about what the market is right now, it ranges completely from AAA to something not so exciting. But that's a good thing. So there are a lot of choices. Obviously, for our long-term capital, we would prefer the investment grades, but there's a lot more competition for those, and the yields are lower. So where you're seeking higher yield, you need to take a little bit of credit risk. And more importantly is understanding what's going on. So in a situation where you have an asset that is regasifying imported LNG and is in some cases singularly responsible to power a city, let's just say a city like Jakarta, for example, you do have an element of, I wouldn't say control, but support that can be helpful when underwriting an investment. And that's the development of this LNG world right now. Everyone is considering LNG as a transition fuel to decarbonize, and that's becoming more powerful. So it is a big concern, and thankfully in the infrastructure world right now, we have options from AAA to something that's not so exciting, but there are ways to support that as well. So it's in a good spot.
And maybe on that, if I could just clarify on the shipping side, we are kind of fortunate where you are more in the AAA zone, maybe not AAA, but at least investment grade. And that's the way it is, because shipping generally tends to be, your customer is normally the upstream player that have got higher credits. Of course, as you go downstream, you start getting emerging market credits and the kind of credits where you do have to pay more attention. But shipping is not so subject to those lower level of credits.
Yeah, I agree with Richard. You know, you have to have big bucks in order to be in the LNG game. So you know, you have a much bigger concentration of the super majors in LNG than in oil trading. So, you know, for Flex, we have 13 ships on term charters, so 5 with Cheniere, 5 with super majors, and the 3 remaining ships are with the big trading houses, which have been making a killing the last couple of years. So we're quite comfortable with the counterparty risk.
So I want to pull forward the conversation on regas, Art, and come back to you. As we touched on credit a little bit, but one of the most active areas for regas and storage has been Europe. There's been a decent amount of momentum there, although maybe not developing as quickly as the market would like. And obviously there are regas opportunities and the potential to deploy relatively high return infrastructure at other pockets of the globe. So maybe if you can get a little bit of color in terms of what you're seeing in Europe in terms of the pace of regas development, and then maybe some other regions of the globe that we might not be focused on where you think there's strong potential.
The action has definitely been in Europe. I mean, there were 11 regasification units secured last year, so incredibly active. That's like 3-4 times what it normally is in a year for the regasification market. And thankfully, almost all of the European projects are government-sponsored because reaction from the Russian invasion of Ukraine. So that's quite investable and easy. When you mention slowdown, there has been a little bit of a pause for absorption, I would say. The inquiry is still there. Europe is still on edge, and I would say the concern is spreading. And that's a good thing for our assets and our investment because the inquiry continues to grow. And most of the sponsors in Europe are governments or investment grade. So it's quite fruitful picking right now. I don't think that it's paused for long, frankly. It's really just absorption and timing because much of Europe wasn't prepared at all, and they're just taking some time to build the infrastructure to receive the LNG, but it will come. So I think it's a process of just absorption right now, but there is more infrastructure that will be developed throughout Europe. And as Oystein was mentioning around ton miles, that pull from Europe maybe shortens the long-haul Asian trade for an LNG carrier out of the U.S. Gulf. But at the same time, the volumes for regasification and growth of LNG use throughout Asia continues. So I don't think it's a short-term thing at all. I think it's the supplies will continue to go both short-haul and long-haul to Asia. And there are developing markets in Asia where, as I was mentioning, that their strategies for the governments are not just the energy transition, where they've been very slow to move up and certainly very price sensitive in some of the non-investment grade countries in Asia. But because of what's happening globally at the moment and what happened in the Ukraine, I think there is a heightened sensitivity around security. And therefore, these conversations are increasing and being followed through. And we've seen already in Europe how governments reacted very commercially. The public-private partnerships in many cases moved at lightning speed compared to what the normal multi-year process is. We're seeing a little bit of that in Asia as well. So it's a really good time. I think the growth of the volumes will continue. We're also seeing a lot of activity in South America, Brazil in particular. There's a number of public and private projects happening there. And so everybody is on edge now. They want to know how are they going to provide power and electricity for their citizens for the next 10 years because of what happened in Russia and Ukraine. And that's a good thing. So it's quite active in the infrastructure now, and so we're quite happy right now.
So maybe going to Richard and sticking with the geopolitical theme. So obviously, the Russian invasion of Ukraine continues to ripple through trade patterns, project build-outs, asset retention, and then you've also had what's happened in the last couple of days in Israel. Can you speak a little bit around the impact that geopolitical risk has for LNG carriers, both in terms of ton-mile, crew safety? Just how do you, when you see stuff like that happen, right? It's been a very busy, year and a half in terms of kind of heightened geopolitical risk. What kind of demonstrable impact does that have on the business?
Well, firstly, it's terrible what's happening over in Israel, and we obviously look at it and we say, well, what impact could that have on our business? I think if it escalates, that's when it would have an impact on the LNG business. Obviously, Israel does export a bit of gas to Egypt, and maybe that ends up getting exported through those terminals. But it's relatively marginal volumes in the big scheme of things, at least at this stage. However, what it does do is that it puts everybody very much on edge when it comes to energy security. And of course, that's not new. They've been on edge ever since the Russian invasion of the Ukraine. And ultimately, it's this kind of thing which holds up the gas price. Now, anyone who's long gas obviously benefits from that. Quite often that's our customers, so our customers are doing quite well. Maybe that helps improve their willingness to pay for shipping. But I think ultimately in a geopolitical context, what people are very focused on is just diversifying their supply. And if you're China, for example, you don't want to have all your supply coming from Qatar. You want to have some coming from Australia. You want to have some coming from maybe Mozambique in the future because of the risk of one particular place being cut off for whatever reason. So people are very much looking at energy in a geopolitical way. They're looking at reducing risk by having it coming from multiple places, and that's why shipping is so essential to this market.
Art, have we seen anything yet?
Geopolitical risk can be positive or negative for LNG. It depends on the context. When Donald Trump went to a trade war against China in 2019, we had the 12 months without any cargoes from US to China on the LNG side. So for that reason, the market in 29 was quite poor because of geopolitical risk. Right now, of course, it's been the Russian invasion of Ukraine has resulted in basically Europe need to replace a lot of pipeline gas with LNG, and they've been, the European buyers have been believing in a liberalized gas market where you don't have long-term contracts, where you just price gas on a hub price. So that means that they have to get all their LNG needs from the spot market, and suddenly you have Chinese sellers selling LNG to European buyers, and this has really driven up prices to crazy levels. We had a 100-fold increase in price from bottom to peak. So bottom was March 2020, $1 per million BTU, went to $100, 26th August 2022. So and right now, of course, LNG prices come down, but they are still elevated. Europe is the marginal buyer, and a lot of the Asian emerging markets have been priced out of the market because they can't compete with European buyers willing to pay this price. Pakistan, Bangladesh, Thailand, Vietnam, you name it. These guys are getting priced out. It's less worse for the big players. Japan, China, South Korea, they're basically almost covered on term deals. So they are not really dependent on the spot market because they have sourced all their LNG needs on long-term contracts and are not really affected by the spot market unless they sell their cargoes to European buyers. But all the developing countries, they are not this access to long-term LNG contracts and need to buy LNG in the spot market, and right now still the prices are too high. Prices are in contango. Prices are going to stay elevated for a couple of years because, as I said, there's very limited new LNG coming to the market 24-25, which will keep prices at a high level. So they have to turn to other feedstocks, and one of them is LPGs, which I will be talking about in the Avance gas LPG panel here. So they are sourcing the cheapest hydrocarbon they can find, and right now it's not LNG.
So maybe shifting back to the industry for a second. And so I remember hosting or moderating a panel like 4 or 5 years ago with a number of public LNG players, none of whom are still public, one of whom is still public today. But the cast of characters has definitely changed. And the dynamics in the industry have changed to the extent that for about a decade, new build LNG carriers cost around $200 million, right? So you can kind of set your watch to it, you have an idea what 70 the reference rate would get you from a cash-on-cash return. You know, that price point has obviously moved up. So I guess my question on asset values, and I'd like to go down the line here because I know it's relevant for everyone. One is 260 sustainable throughout the course of a cycle, right? When we start to actually see relets on this tonnage, or do you think it rolls over? And then going in the opposite direction, I don't think yard margins are particularly wide at 260. Is there room for them to continue to move higher as we see inflation and every other aspect of the value chain? So maybe Art, starting with you and then going to Richard.
I would say that $260 million is not sustainable. It's an extremely high price by historical standards. It feels okay now because you can lock it up at a double-digit return on a multi-year charter, so that sounds fine. But as Oystein mentioned, the relet market of the oil majors, the energy majors, could become a factor as time goes on. But the compounding factor is the cost of capital and interest rates. And at least in my own career, when we see prices at all-time highs for 18 months, 24 months, with interest rates moving to, you know, nearly all-time highs and moving with a dramatic shift where the cost of capital takes time to kind of filter in, it doesn't feel like it should be sustainable. There continues to be inquiry. That's a little tough to explain sometimes. There are many suppliers that are out looking for ships. Some of the tenders that you're mentioning, they're immune to the independent ship owner. So overall, I think that if I had to answer the question, I would say it's probably not sustainable, and that at some point we're going to see a rationalization of more long-term numbers.
Well, firstly, I think there's a lot of ship owners out there which are not public that have actually found themselves caught out by this change in rates. So you get a lot of people calling up saying, would you like to buy an LNG carrier? And you say, interesting, 260, and they go, yeah, 260, but today. But then you ask, okay, what about the contract? And they say, they go a bit quiet then, and eventually you kind of get it out of them that it's on a 10-year contract with 2 5-year options at $60,000 a day, and they haven't fixed their rates. So when you do the maths on that, they are basically a zombie company because there's no cash flow to equity going forward at those levels. So that's actually pushed a lot of the kind of new capital that we saw coming into the sector a little while ago out of the market, I think. You still have Japanese capital out there, which is quite cost effective. So there's strong competition there. Is the 260 sustainable? Well, I think we have seen a bit of a tailing off of new build orders at that level. I don't see Oystein ordering any new ships, and obviously he's in a position where he could if he wanted to, so I'll let him answer the question, but I think I know what the answer is going to be. But do I think it's going to come down? No, because the yards are not making money at that level. The average age of a welder now in Korea is said to be in the late 50s. People are starting to get comfortable with Chinese vessels, but it's really only one yard in China that's got any experience. So there isn't a whole load of competition at a lower price point. I think our feeling is that prices will creep up to reflect the cost of new build shipping, but there'll be a gradual tailing off in orders, because whether the market's able to sustain those on a value chain basis, I think is very much open to question.
No, I agree. I think it's getting too elevated. Although that said, 15 years ago I was with Knutsen and we ordered ships then at 235. So that's 15 years ago. Long-term yields at that time was slightly above 5%. So in that sense, 15 years, you haven't really had a lot of inflation. Lead time for the ships were 3 years. So, but still, I do think it's a bit elevated, and especially given the fact you have 50% order book to fleets. Would you like to add more to that fleet? The yards are very comfortable. There's just a couple of 27 slots left. The yard Richard mentioned in China, they don't have any more 27 slots available. They are booking 28 today. Qatar will order a lot more ships and keep the yards busy every time they order a ship. The yards are losing money and crying. You saw the recent Qatari order, average price 230. When the Qatari reserved 151 berths at the three Korean yards and Hudong in China, they had a price formula very favorable to Qatari, and that's why the yards are losing money on every order, and that's why you see this low sticker price on some of the Qatari orders. So that means that the yards need to make up some of the loss on the more kind of speculative new buildings or the outside new buildings, but contracting has tapered off. So that's at least a good thing. You know, we got to such an elevated level. You don't contract a ship unless you have to, and you have a specific project. When we contracted for 15 years ago at 235, at least you get a 20-year contract. Today you are lucky if you get 10. So that increased the risk of maybe getting your money back on that huge investment.
Newer entrants into the space and PE-backed owners that were particularly active in dragging those rates down. Richard, you mentioned 60K with 5-year back-to-backs on it, which rings pretty true. How would you contrast the competitive balance today versus what we saw last cycle? Do you have more rational players in there today that might be able to hold the line on rate a little bit?
One of the reasons why people were lowballing and going to these crazy, ridiculous rates for $60,000 for 10-year deals was you had a lot of players with, if you've seen that movie with Danny DeVito, other people's money. That's the problem. So you have a kind of a broker contracting ships, and then you get other people's money. And that happens when interest rates goes to zero. So when Fed have been keeping this interest rate at artificial low levels for such an extended period of time, you get crazy money. And this crazy money went also into LNG, contracted a lot of ships because they thought it was very easy to get a 10, 15 years contract, and suddenly when the market came down during COVID, these guys got desperate. So they got basically a rate which were able to sustain the debt capacity on the ship, and there's nothing left to the equity owners. So I think it's different today when you can get 5.5%, lending to the US government. Why chase this kind of deals? There's not really a lot of these players left, and that's, I think, will create more discipline by the owners.
If the question is about new capital into the industry, I think that where LNG comes into play is around the infrastructure theme, and most of the new capital providers, private, are not interested in the commodity play. They're not taking spot market risks. They are interested in longer term income generating contracts, because what we've seen in the last 10 years or so is a disappointment, generally speaking, where there was new equity coming into the market, say 2010, that through the volatility of dry bulk and tankers and LNG even back then, didn't really have a successful outcome. So that income for more speculative private equity, pure private equity, went away, and you don't see interest from the pure private equity today like you did then, and even hedge fund. What you do see now is more long-dated capital and infrastructure oriented, and I can also speak for now the Apollo funding that is the majority owner of Energos infrastructure. It is really perpetual capital. It is insurance capital. It is pension fund oriented. So it fits when you have long-term contracts, and that's a shift. So I think in the last 5 years or so, we've seen re-emergence of new capital coming in, but it's different capital than before. It's not willing to take that spot market risk because that's just too volatile. And that's here to stay, because when I say infrastructure capital, mentioning again the current blending of two themes, the world, and when I say the world, the finance world, capital providers are wanting for sure to decarbonize and also needing to. So where can you put money into? LNG is a perfect place because it's a growing market. There's huge supply coming online, very capital intensive, and it's going to stay, and it's a good thing that it also decarbonizes the world. Maybe it's not completely sustainable the way solar or ammonia or hydrogen can become over time, but right now, if you want to generate the same amount of electricity and power generation for large populations, LNG is a perfect spot to transition as we're figuring out long-term decarbonization. So that's also the reason, not only the income, but also the purpose of infrastructure funding, and I think it's here to stay.
Anything to add, Richard?
Just quickly, I think all the owners have been strengthening their balance sheet, and there is a recognition amongst customers that they want to go with good, experienced owners, which maybe has not always been the case. And then lastly, this notion that LNG is going to become a spot market like the tanker business, that's completely out of the window now. So I think there is hope that the rates do stay quite firm and people maintain their discipline.
It's a good place to end. Thank you all for the time. Thank you for joining us. And Nick, we'll hand it back over to you.